All right, let's dive in. Today, we're going to borrow a page from Warren Buffett's playbook to decode a stock. And the company we're putting under the microscope is a huge one, American Electric Power. Let's see what story the numbers tell. You know how it is. You start looking into a company and you're just hit with this wall of numbers. PE ratios, profit margins, debt levels, it's a lot. It can be totally overwhelming. So the real question is, what actually matters? How do you cut through all that noise to find out what's really going on?
Well, we're not going to reinvent the wheel. We're just going to borrow a simple framework inspired by one of the best to ever do it. This isn't about some crazy, complex math. It's all about asking a few clear, logical questions to get to the heart of the matter.
So first things first, let's lay down the ground rules. This is the yardstick we're going to use to measure American Electric Power. It's a simple, three-part checklist designed to see if a company really has what it takes.
Here it is. It all boils down to three simple but super powerful questions. First, is this a durable business with a real history of success? Second, are its finances healthy right now, today? And finally, third, is the stock being offered at a fair price? Let's tackle them one by one.
All right, let's kick things off with that first question on our checklist, durability. We're looking for a company that's proven it can go the distance, that it can consistently deliver for the people who own it. So, how does American Electric Power measure up? Let's start by zooming way out. Look at this number, a 785% total return over 20 years. Just think about that for a second. An investment in AEP 2 decades ago would have grown by almost 8 times. That is exactly the kind of long-term steady growth that screams stable business. And hey, that's not just some fluke from a long time ago. Let's zoom in a bit. Over the past decade, the company has delivered an average annual return of over 11%. This shows a pattern of really consistent, solid growth in more recent years, too. So far, so good. The track record looks pretty darn strong.
A strong stock price is great, for sure, but another huge sign of a durable company is how it treats its owners. Does it actually share the wealth?
And this number, wow, 16 consecutive years of dividend increases. That's more than just a number on a page. It's a massive vote of confidence from the people running the company. It signals they're confident about the future and committed to putting cash back in shareholders' pockets year after year. That's a huge check in the durable business box. Okay, so the track record? Check. It looks solid. Now it's time for question number 2 on our list. How are the finances looking today? It's time to pop the hood and see what's really going on with the engine right now. Our first stop is a metric called return on equity, or ROE. Don't let the name scare you. It's a pretty simple idea. Basically, it asks, for every dollar that shareholders like you have put into the company, how good is the business at turning that into profit? The higher, the better. Right now, AEP's return on equity is at 11.48%. But here's the really interesting part. That's actually higher than its average over the last 3 years. That tells us that the company's profitability is actually trending in the right direction.
Next up, let's talk about the big one, debt. The debt-to-equity ratio just tells us how much the company is borrowing compared to how much of its own money it's using. Now, for a giant utility company, you fully expect to see a lot of debt. I mean, building all those power plants isn't cheap. The real question is it manageable? So for every dollar of its own money, the company has about $1.57 in debt. But look closer. That's actually come down a little bit from its recent average. So yeah, the debt is significant, but at least it's not growing. We'll call that another small positive sign. Okay, so far, things are looking pretty good. But here's where we hit our first real speed bump. You could call it a flag on the play. The company has negative free cash flow. In simple terms, that means after all the heavy spending to build and maintain everything, they're actually burning through more cash than they're bringing in. And for a company that's also paying out a steady dividend, well, that definitely makes you raise an eyebrow. This leads us perfectly into our third and final question, and honestly, it might be the most important one. You can find the best company in the world, but if you overpay for it, it can still be a bad investment. So, is American Electric Power being offered at a fair price? Let's check the price tag. The most common way to check that price tag is the price-to-earnings ratio, or PE. It's pretty straightforward. A higher PE just means the market is putting a higher price on the company's profits. We're going to compare its current PE to its own recent history to get some perspective.
AEP's current PE ratio is just over 20, and if you look, that's a bit higher than its average over the last 3 years. So what does that tell us? It suggests the stock is trading at a small premium compared to where it's been lately. It's not dramatically overpriced, maybe, but it's definitely not in the bargain bin either.
Now for another angle on valuation, margin of safety. Some formulas try to calculate a company's true or intrinsic value based on its earnings. And according to this calculation, the current stock price might be about 30% above that calculated value. Now, it's just one metric, but it's another piece of data telling us to be a little cautious about the price tag right now. So, we've gone through our 3 big questions. Is it a durable business? Are the finances healthy? And is the price fair? Now it's time to put all the pieces together and see what our final scorecard for American Electric Power actually looks like.
Okay, let's break it down. On the positive side, we've got that fantastic long-term track record, an incredible 16-year streak of dividend growth and profitability that's actually on the upswing. Those are some heavy hitters. But on the cautionary side, we have a lot of debt, even if it is stable, and that negative free cash flow that we just can't ignore. And on top of all that, the stock seems to be priced a little bit above its recent average.
And this right here is the most important takeaway. Following a checklist like this isn't about getting a simple green light or red light. It's not a magic 8-ball. What it does is give you a balanced view. It forces you to see the strengths and the weaknesses, giving you a structured way to think about any potential investment.
The real power of this framework is that you can use it on your own. These same 3 questions, durable business, healthy finances, fair price, you can apply them to almost any company you can think of. So that leaves me with one question for you. Now that you have the tools, what company comes to your mind? What would you check next?